BigBear.ai is currently trading at 5.84 USD, representing a sharp intraday decline of 6.43% as of 11:12 a.m. ET on this Thursday, January 22, 2026. While the broader technology sector is trying to find its footing, this specific move in BigBear.ai highlights a growing tension between what the market expects from artificial intelligence firms and the harsh reality of their balance sheets. Most investors looking at this ticker see a small-cap player that should be catching the tailwinds of the current intelligence boom, yet the reality is much more complex. Today, while the price is slipping, the company actually announced the acquisition of assets from 𝐅𝐍𝐂𝐂𝐋, a firm specializing in automated inspection and trade risk management. You might expect a growth-oriented acquisition to spark a rally, but the market is reacting to the dilution and the ongoing struggle to turn these capabilities into consistent bottom-line results. This creates a curiosity loop for the patient investor. Why would a company with a negative net margin of over 270% continue to acquire new assets while its stock price is hitting technical sell signals? The common ground among retail traders on forums like Reddit and X is that BigBear.ai is a more affordable alternative to Palantir, often labeled as a sleeper hit that just needs one massive government contract to explode. However, the contrarian view, and the one being signaled by the recent heavy volume on falling prices, suggests that the market is losing patience with the slow pace of government procurement. If you look at the trading volume today, it is already exceeding 15 million shares, which is a massive spike compared to the typical session. This isn't just retail churn, this is institutional repositioning. When you see volume rise while the price drops by more than 6%, it is an early warning that large holders might be exiting their positions or that short sellers are intensifying their pressure. You have to ask yourself, is the market missing the long-term value of the 𝐅𝐍𝐂𝐂𝐋 deal, or is it correctly pricing in the exhaustion of a company that has seen its revenue decline by 20% year over year? Comment below how many shares of BigBear.ai you currently hold, or if you are waiting for a specific price floor before considering an entry. The recent stock movement has been a textbook example of technical breakdown. After hitting a 52-week high of 10.36 USD, the stock has been caught in a wide and falling trend. Today's low of 5.71 USD is testing a critical support level. If this level fails to hold, the next major accumulation zone isn't until the 5.33 USD mark. The Moving Average Convergence Divergence, or MACD, is showing a buy signal on a 3-month basis, but the short-term and long-term moving averages are still issuing sell signals. This conflict often traps retail buyers who look at one indicator in isolation. The reality of the situation is that the long-term average is sitting comfortably above the short-term average, which is a classic bearish configuration. Institutional activity from firms like Cantor Fitzgerald, which recently downgraded the stock to neutral, reinforces this cautious stance. They dropped their price target from $7 to $6, which is almost exactly where the stock was hovering before today's slide. When analysts move their targets closer to the current price, they are essentially telling you that the near-term upside is capped. One of the most demanded insights in the current market environment is the level of short-selling pressure. As of the most recent data for January 2026, BigBear.ai has a short interest of approximately 107 million shares. This represents nearly 25% of the public float. This is a massive number that indicates professional traders are betting heavily against a quick recovery. The days-to-cover ratio is currently sitting around 1.2, which is relatively low because the daily trading volume is so high. A low days-to-cover ratio usually means a short squeeze is less likely because shorts can exit their positions quickly without causing a massive price spike. However, you should be monitoring the borrow rates. If you see the cost to borrow these shares start to climb above 15 or 20%, that is when the pressure on short sellers becomes actionable. Currently, the borrow rates are stable, suggesting that the bears are comfortably in control. Retail sentiment on social media is often focused on the idea of a squeeze, but without a significant catalyst or a spike in borrow costs, those expectations often lead to disappointment. What is your take on the rising short interest? Do you think the smart money is right to bet against the company, or are they ignoring the potential for a surprise contract win?
To understand why this company is so polarizing, we have to look at what they actually do. Based in McLean, Virginia, BigBear.ai provides what they call decision dominance solutions. This is essentially high-end analytics and cyber engineering primarily for the national security community. They use AI to process massive amounts of data in real time, at the edge, meaning the processing happens where the data is collected rather than in a distant cloud. This is a critical distinction for military applications where a connection to a central server might be compromised. Their business model relies on two main pillars: cyber and engineering and analytics. While their tech is highly specialized, their financial performance has been a point of contention. In the most recent reported quarter, they posted a loss of 7 cents per share, missing the consensus estimate of 6 cents. Revenue came in at 33.14 million USD, which was a slight beat on expectations, but still reflected a 20% decline from the previous year. This is the heart of the expectation versus reality tension. The tech sounds vital and advanced, but the financial statements show a company that is still trying to find a path to profitability. Looking at the institutional landscape, there are some interesting shifts. While insiders own less than 1% of the stock, which is often a red flag for investors looking for aligned interests, institutional ownership is around 33%. Large players like Citadel and Renaissance Technologies hold positions, but they are often using these for complex quantitative strategies rather than long-term conviction bets. The recent conversion of 125 million USD in senior notes was a necessary move to clean up the balance sheet, but it also resulted in significant shareholder dilution. This is why the price remains under pressure despite some positive news cycles. Investors are effectively paying for the debt reduction through the decreased value of their individual shares. This is a common theme with companies that went public through special purpose acquisition companies, or SPACs. The initial hype creates an expectation of rapid growth, but the reality of the public markets demands disciplined fiscal management, which takes time to establish. Actionable steps for anyone watching this stock right now involve monitoring the options open interest and the fail to deliver data. If you see a surge in out-of-the-money calls alongside a drop in short interest, it could signal that the tide is turning. But for now, the technicals and the sentiment are leaning heavily towards the bearish side. You can find short interest data on platforms like MarketBeat or NASDAQ to keep an eye on these shifts. Also, keep a close watch on any new government contract announcements. For a firm like BigBear.ai, a single 100 million USD contract from the Department of Defense can change the entire narrative overnight. But until that happens, the stock is likely to remain volatile and sensitive to any macroeconomic pressures, such as interest rate changes that affect high-growth, unprofitable tech firms more than established blue chips. The debate on Reddit and X often centers on whether this company is a junior version of Palantir. While Palantir has successfully transitioned from being a government-heavy contractor to a commercial powerhouse, BigBear.ai is still very much in the early stages of that transition. Their partnership with the Kraft Group and the New England Patriots to drive digital transformation is a step in the right direction for commercial adoption, but it currently lacks the scale to offset the fluctuations in their government business. This is another area where expectations often get ahead of the reality of the sales cycle. Selling software to a professional sports team or a logistics firm is a completely different process than navigating the bureaucratic hurdles of a defense contract. Investors who are calling for immediate results are often the same ones who end up selling at the bottom when the quarterly reports don't show an instant transformation.
As we look toward next week and the coming months, the catalysts to watch are the integration of the CargoSeer assets and the potential for new mission-critical contracts. The company has a strong liquidity position with current ratios above 3, meaning they aren't in immediate danger of a cash crunch. Their debt-to-equity ratio is also low at 0.18, which gives them some room to breathe. However, the market is currently valuing them at about 17 times sales, which is quite high for a company with declining revenue. This valuation premium is built entirely on the expectation of future AI dominance. If the company cannot prove that it can grow its top line, that multiple will likely compress further, bringing the stock price down even if the broader market stays flat. Do you think the recent downgrade by Cantor Fitzgerald was a fair assessment, or are they just reacting to the short-term price action? In summarizing the current state of BigBear.ai, we see a company at a crossroads. The live price of 5.84 USD and the intraday drop of over 6% reflect a market that is skeptical of the company's ability to execute on its high-tech promises. The expectation was that the AI boom would lift all boats, but the reality is that the market is becoming more selective, favoring companies with clear paths to earnings over those with just potential. The recent acquisition and debt restructuring are positive long-term moves, but they haven't been enough to overcome the bearish technical signals and the heavy short-selling pressure. The 25% short interest is a hurdle that will require a major positive surprise to clear. For retail investors, the key is to look past the social media hype and focus on the fundamental data: revenue growth, contract wins, and the cost of borrowing for shorts. The tension between the innovative nature of their edge AI solutions and the stagnation in their financial growth is what will define this stock for the rest of 2026. If the reality of their business starts to catch up to the expectations of their most vocal supporters, the turnaround could be significant. But if the revenue continues to slide, the current support levels may not be enough to hold back the tide.
Always remember that in the world of high-volatility AI stocks, the gap between what people believe and what the data shows is where the real risk lives. BigBear.ai is a perfect example of this. It has the technology, it has the government connections, and it has a cleaned-up balance sheet. But it lacks the one thing the market wants most right now: consistent, profitable growth. Until that changes, expect the volatility to continue. Monitor the days to cover and the institutional filings closely next week. If you see firms like Citadel increasing their stake, it might be a sign of a bottom. If they continue to trim, the downward pressure will likely persist. Keep your eyes on the data and don't let the narrative drive your decisions more than the numbers do. This is a high-stakes game where the winners are those who can distinguish between the noise of a daily swing and the signal of a long-term structural shift. The current intraday movement is a reminder that even in a sector as exciting as artificial intelligence, the laws of finance still apply. Would you like me to look into the specific fail-to-deliver data for BigBear.ai over the last month to see if there is evidence of a more aggressive short attack?